Debt has a remarkable way of splitting the world in two. For the average person, borrowing money is a heavy burden, a source of deep anxiety and financial distress. Yet, if you look at how corporations and billionaires operate, you'll see them actively taking on millions, even billions in liabilities on purpose. This behavior isn't recklessness. In 1958, two economists, Modigliani and Miller, proved that up to a certain point, a company taking on debt actually lowers its overall cost of capital. At the highest levels of finance, debt is a calculated structural tool used to make money more efficient. The problem is that most of us apply a one-size-fits-all moral judgment to borrowing. We treat a maxed-out credit card and a commercial real estate loan as the exact same thing, which leads to catastrophic financial mistakes. If you are drowning in consumer liabilities, you need a strict survival strategy. Prominent financial personalities have built empires teaching people to treat debt as the ultimate enemy, a zero-tolerance approach required to break toxic cycles and regain control of your life. But listen to other voices in the wealth-building space, and they advocate the exact opposite. They teach that borrowing against cash-flowing assets is exactly how you generate passive income. The general public judges debt based on the psychological stress it causes. Investors judge it based on the mathematical function it serves. Feelings lie, the math doesn't. At its core, debt is entirely neutral. It is simply a financial multiplier. It takes the trajectory of whatever asset it is attached to and hits the fast-forward button. This makes defining bad debt an objective calculation. Bad debt is money borrowed at a high, non-tax-deductible interest rate to purchase something that immediately drops in value. Modern consumer credit has historically conditioned the public to accept negative friction. Ever since the widespread adoption of charge cards in 1959, we have normalized tying our future labor to our past consumption. This creates a mathematical double hit. First, you lose equity because the television or car you bought is losing value every day. Second, you bleed cash flow to cover the high interest rate attached to the loan. Bad debt guarantees your future income is enslaved to past consumption. It is a mathematical certainty that your total net worth will shrink. Good debt does the exact opposite. This diagram shows the cost of borrowing as a flat red line, while the green line represents the yield of an asset. Good debt is borrowing money to acquire an asset that generates a higher cash flow or appreciation rate than the total cost of the loan. Let's look at an advanced strategy used in Australia called debt recycling. You start by paying down your non-deductible home loan, building up equity. Then, watch what happens on this balance sheet. You re-borrow that exact same equity to invest in income-producing assets, effectively changing the label of the debt from non-deductible to tax-deductible. This restructuring acts as a powerful tax shield. The interest you pay on that new loan is now tied to an investment, meaning you can legally deduct it to reduce your taxable income, while simultaneously building a diversified portfolio. To be clear, this is not negative gearing, where you lose money on an investment just for a tax break. This is a deliberate structural balance sheet reorganization designed entirely to increase your long-term tax efficiency. The wealthy do not simply endure debt, they actively engineer it to legally bypass tax burdens and multiply their purchasing power. There's another counterintuitive advantage to borrowing, and it involves something we usually fear: inflation. While inflation destroys the purchasing power of your cash, it acts as a silent wealth generator for strategic borrowers. When you take out a fixed-rate loan, the nominal value, the actual dollar amount you owe, stays exactly the same over decades. But the real value of that debt decreases as inflation devalues the currency. Think about how historical prices compared to today. Gas, groceries, and wages have all surged. If you own an asset, your rental income and asset value rise alongside that inflation, yet your monthly loan payment stays anchored in the past. This brings us to a gray area. A mortgage on your primary residence, or even a student loan, doesn't generate immediate cash flow, but they offer future earning potential or tax exemptions, making them a long-term wealth vehicle rather than a purely good or bad debt. In an inflationary economy, sitting in cash guarantees a loss. Meanwhile, strategically held fixed debt mathematically erodes itself for free. So how do you actually apply this? It comes down to a three-step assessment. First, determine if the debt is financing a growing asset. Second, verify that your interest rate is lower than your expected market return. The third and most critical step is stress testing. You have to ensure that your loan payments can be sustained even if your personal income drops or the market takes a sudden dip. Failing to stress test leads directly to the over-leverage trap. Because leverage amplifies both your gains and your losses, stretching your good debt too thin means a minor downturn can wipe you out, like a single foundational block bringing down an entire structure. Surviving this trap requires immense emotional discipline. You need the ability and the capital to hold your asset through a full market cycle without panic selling at the bottom. Take a look at one current debt you hold today. Override your emotional bias, ignore the anxiety for a moment, and run it through this mathematical framework. You'll know exactly whether that debt is a tool or a trap.